We're rolling, I think. And I'll turn this on as well.
And the presentation will come up.
Yep, let's go over. Okay.
There we go.
Okay. They get silence. Not sure. Let's see. It says it's on right now. So. Yeah.
So they'll remotely turn it on.
He'll turn it up for us, I think.
Yeah, sounds good. You start putting makeup on some of these TV shows. Putting makeup on some of these TV shows they're putting on blush, right?
I do have to get it done occasionally. Yeah.
Sometimes you're looking like an orange guy.
Well, actually, quite a bit of time when I go back home to see the family that way.
Yeah. It's better.
So let's get started today. Thank you very much for coming. Thank you very much. Appreciate seeing everyone here. I will try to be brief. I have written it down here. The commercial sites. Welcome on behalf of Town Hall. They have been very good to us in providing this venue at reasonable price, and we appreciate it. So, one also on behalf of the Seattle Economics Council, the region's forum for economists. Our monthly luncheons at Irish are open to practicing retired economists and to students and those just interested and motivated. You know who you are. If you have the rogue chromosome and an economist, come down and see us. We thank our outgoing president, Sarah Lauer, whose tenure has been very productive for us. This past season, we've had an Economics Council Steve Lurch, State's Chief Forecaster, Dick Conway, Gary Smith, who's here today, Bill Bryan from the Port, Matthew Gardner on real estate, Jerome Ballman, stand-up economist, Dan O'Neill, and just last time we had John Talton of the Seattle Times, which was very good. In June, we'll hear from Ross Hunter, provided the legislative session is over, chair of the House Ways and Means Committee. Also, welcome on behalf of the Demand Side Economics, the website, the podcast, the book, also available here today. We intended to have a university bookstore here today. They have not yet shown up, so hopefully they'll show up in time so we can get Steve's book to you as well. Anyway, also the book, also the tradition, John Maynard Keynes to and the New Deal through, although I haven't cleared this with him, speaking and the heterodox economists of today. I must say that as we're trending registrations leading up to today's event, it became apparent that our membership was not fully supporting us. We have many of them here, Chandler, Bruce, Bob Food, Chuck. There are quite a few here, but nor was the broader academic community united. They know about this event, I assure you. Is there anyone from the University of Washington? There remains a reluctance to engage among economists, in this case, a reluctance to engage in financial markets and nature of money. And to acknowledge that economics, as usual, has failed. It failed to predict the great financial crisis. And we are muddling through now because economic leaders are stuck in economics that doesn't work. Did not work. There are enormous consequences in the current climate, not only for people who are trying to invest intelligently, and we thank Gerard for being here to represent them, but there are consequences for working people and for economic thought. The absence of engagement today, maybe because Steve he gives no quarter of the debate. He refers to me in classicals as Ptolemaic astronomers who still believe the universe has been evermore. They'll ever consider spheres to explain things. But economics is or should be a science based on evidence, on hypothesis and testing, where the great economics crisis is a wonderful laboratory. Karl Popper said that predictions and explanations are symmetrical and reversible. Meaning if your explanations are good, your predictions are good, and if not, you need to change things. There is evidence, there are predictions. And I realize that some of you people I reference will be at the later event. But we cannot ignore the fact that economics as a discipline is still content on burying its head in the sand. So the title tonight, The Great Financial Crisis, and the title of tonight's talk by Steve, The Great Financial Crisis and the Great Recession, how we got there on the way out. Enough of that. One last point. The general debate, though not the specific debate here, is exactly the same as what occurred in the 1930s. Exactly the same. Same language, same fight. And not to be discouraging, but it was not the Enlightenment economists in the 1930s that reformed economic thinking, but rather the intensity of the crisis, not only the first one, but the second one in 1937, which propelled economics to reform. And today, again, the debate will not be won by logical results, though they are essential if we are to find a way out. Change will likely come from the economic forces. Now, thank you for that indulgence. Today, I have asked each person, Gerard and Steve, to introduce themselves better, and I will in a moment, by describing where they were and what they were doing at the time of the great financial crisis. And so that will be a better introduction. But briefly, Steve is here from Australia and from the rest of the world. He has been cited as the economist who, among all others, predicted the great financial crisis and the Great Recession, both in scale and timing. He received a Revere Prize from the Real World Economic Review after a vote of over 2,500 economists worldwide, pulling ahead of such others as Muriel Rubin, Dr. Dew, Dean Baker, Joseph Stiglitz, and Robert Shiller. Again, visit us this evening. Oh, yes, this evening, 4:45, about we'll have a reception for the very informal reception before the evening event. And it's free for everyone with a name tag. So it includes all of you. And you will be signing those books at that time too, provided them there. So we are very grateful that he has made the effort to be here, which was not a small effort. Gerard Fitzpatrick is a native of Ireland. And I should note that both of these guys have a lot of energy, speak quickly, and have an unfamiliar dialect, so it will be a challenge in another way. He is now based here Gerard is now based here in Seattle with Russell Investments. He operates in a very challenging environment of today's financial markets as a strategic bond fund manager. During the global financial crisis period, he was global bond portfolio manager who is stationed in London. And one of the largest of these funds, Russell's RIC2 Global Bond Fund, garnered numerous awards from Lipper, including best performing fund in its class over 3 to 5 years. So he is skilled and willing to do that. inside a pressure-packed environment. Although Irish, as I mentioned, Gerard has spent his professional life entirely outside the country in London, Bermuda, and the United States. A passionate advocate of continuous education, Gerard presently has 3 degrees, 4 professional qualifications, and is an avid follower of best investment practices from across the globe. Personally, he has survived the ultimate left tail risk, as he calls it, with a successful bungee jump. Must have prepared him for the crisis. I omitted a portion of my introduction to Steve because it was too long. But this is a part about a bet he lost in Australia, and then which resulted in his trek to the highest point in that part of the world. I'll put that up on the website as soon as I get the details, or maybe he'll tell us about it. The point of that story, however, was that this particular trek, the bet he lost, ended up in benefits for homeless in Australia. The point of the story, and also with regard to Gerard, is that these 2 men have both escaped the obsession with self-interest, sometimes trained into economists. Gerard helped raise over $500,000 for United Way last year as co-manager of Russell's United Way campaign. So perhaps too much introduction. Let me get out of the way. Gerard will begin, then he will hand off to Steve for another segment, and then we'll get into Q&A and discussion. At that time, please ask your question, no matter how dumb it might sound in your ears, because that's the question you answer. So without further ado, Gerard Fitzpatrick.
Okay. Thank you very much for the introduction, and I'll try to adjust my voice to make it a little bit more sounding for local dialect here. I've been here for a year and a half, and well, from England, my daughter started off with an English accent, but now she's got an American accent, so very, very pleased to report that. She also says words such as things are awesome rather than not too bad. So personally, I find that awesome myself. So I'm delighted to be here. Thank you for that. Thank you to the Seattle Economics Council for the invitation here to be today, and also for everybody's attendance. It's a great honor to be up here with Steve Keen today. I should emphasize that I see this somewhat like one of those concerts you go to, where I'm the warm-up act, but Steve, of course, is the main show, and I'm sure you'll see the difference in quality coming through very quickly as well. But what I do offer is some experiences investing money directly. I've been a fixed income manager for over 20 years. I managed our global bond fund within Russell in London through the financial crisis, got through that unscathed and managed to make some successful investments through that. So I'd like to share some of those with you, and then bringing it to today's market about some of the key issues that I see in the world of investments, with particular focus on fixed income, and where I see some of the main risks to consider as well. So you can see from my background as an experienced fixed income manager, going through the financial crisis, living it today, managing US fixed income funds, taking risk in the market today. I'll share that with you, what risks I'm taking and why. To kick it off, though, there's a few primer slides which really gets into about the subject of money and what the Fed is doing, and the subject about quantitative easing. And that's in many ways a backdrop to the opportunities or to the risks that are ahead of us. And that will be a main area of focus for Steve's presentation. So with that, let me kick off with some of these slides before going through some of my own experience and my own views on the market. So first of all, the Fed. What's the Fed doing, and what's going on with money supply? This will be a question several people here will have. First thing is that the Fed is printing a lot of money. You can see the blue line there. What the Fed is doing through quantitative easing is that it's buying treasuries, it's buying mortgage-backed securities, it's expanding its overall balance sheet. So it's an unprecedented level of Fed balance sheet expansion. However, the money supply is not growing that much, and that's a key issue. The question then is, well, why is the money supply not growing that much if the Fed is growing its own balance sheet? And it's to do with, on this slide, you'll see that the banks are holding the cash. So the Fed does is, through quantitative easing, is it buys these securities from banks, and the banks then receive the cash, but then the banks are holding the cash. So the excess reserves held by the Fed is very large, and an exponential increase in that number recently. The Fed has been highly innovative. If you go back here on the left-hand side in December 07, not much activity, pretty steady balance sheet, not much activity. In the green is mainly treasuries. The Fed would buy treasuries and hold them, but not much extra activity going on. 2008 occurs and the whole game changes. The Fed feels it has to act, and that's a key point I'm making, is that the Fed feels that unemployment is unsatisfactory, it feels that the stock market's unsatisfactory, it feels the financial system's unsatisfactory, and the Fed felt it had to act. So it has done so through several different measures. You can see the colours there, the short-term lending to financials to provide effective liquidity to prevent financials actually going bust. There's currency swaps to provide liquidity to other foreign central banks to make sure that there's adequate liquidity, particularly for US dollar assets. And then what we can see from the start of the quantitative easing is a big increase in the amount of agency debt and MBS as well as treasuries. And that's all part of the quantitative easing action. So why is it doing it? It's the monetary policy through the crisis. It's the Fed's belief and aspiration that it needs to act rather than just to allow free market forces occur. And that is a massively debatable subject, whether the Fed should have done it or not. Some could take the view that if the Fed didn't act, there could have been a huge financial crash, a huge economic meltdown. Some would take the view that the action that they've taken is now leading to big uncertainty going forward, and we'll talk about that. So what's the Fed done, and what's the impact firstly on treasuries? Well, the yield on safe assets has collapsed. The Fed has bought treasuries through its programs, quantitative easing programs, Operation Twist, selling short-dated debt, buying longer-dated debt, and through outright purchases. And with that, the Fed being a big buyer within the market, and also with the backdrop of uncertainty, it means that the bid or the demand on financial markets for treasuries has been extremely strong. So 2-year treasuries there in the red, they've collapsed to almost 0%. 30-year treasuries at all-time lows, 10-year treasuries at lows as well. We hit a low 160 recently. It's now 2%, but very low levels as a result of the Fed trying to keep treasury levels low. Lower cost of financing is considered to be supportive to invest in higher expected return assets. And that's what we've seen. So what's quantitative easing? Well, ultimately, it's a case of a measure to try to stimulate the economy. The Fed, what they'll do is that they'll electronically print money. They'll use that. They'll buy securities from the banks. The Fed holds those securities. The banks hold the money. And the hope or the aspiration that the Fed would have is that the banks with greater reserves could actually lend the money. They lend the money, that's good for the economy, it's good for employment. But what we've seen is that hasn't really fed through fully. However, there have been some signs of improvement within the economy, and clearly risk-on financial assets have done very well. So that really explains some of the activity. But the key point here is how's it supposed to work is keeping treasury yields at a low rate is considered positive for investors in investing in higher yielding assets, but also as well in mortgage owners. Interest rates relatively low, that should be positive for house owners, and we've seen that. We've seen some improvements related to overall the housing sector, and that's fed through to housing-related debt in financial markets as well. That when housing-related debt becomes more attractive, it's a stronger base for improvements in overall house prices. Stocks clearly buoyant. You can see the different activity there with regards to the different quantitative easing activities and what's happened to the stock market. Ultimately, the Fed has really fired up the stock market. Very, very low interest rates. People are allowed to borrow at cheap rates. They can borrow on margin. They can invest in higher expected return with leverage. And what it's doing is it's providing additional private sector demand for risk-on assets. So people feeling good about themselves again, investors feeling good, and that's really buoyed the stock market. Other factors such as improvements in some of the unemployment rates and in the housing sector, that's all been positive as well. So that's a bit of the background relating to quantitative easing and the Fed. And Steve will talk about that in more detail and where some of the specific concerns are from that. But what I wanted to do now is kind of step back a little bit. So from the market, my own experiences as a fixed income manager. And you'll see this as somewhat frightening, somewhat hilarious, somewhat interesting. But what it is it's direct quotes from other fixed income managers that I work with in terms of their views on the markets. What I wanted to do is I wanted to share with you what really happened in the financial crisis. As a bond manager, what were we thinking? What was the real shocking events? And in some ways, these three factors really encapsulate a lot of the activity of what did occur, but also, interestingly, they pointed towards what's potentially coming on the horizon as well. And the first one is this, the performance of some securitized assets. The quote is, it's like buying a bag of air. Now, we're talking about hundreds of millions of dollars invested in AAA securitized assets. High quality, can't go wrong. These are bank balance sheets, insurance companies, best investments ever, and all of a sudden it's a bag of air. So you could imagine the sense of sort of disappointment with those type of assets. The next one is investment managers pride themselves on trying to do good performance, but the answer is never to be heard before was we're somewhere between disappointed and disgusted with ourselves following our performance in 2008. It truly was absolutely shocking. Never before in our lifetime experienced anything like that. The whole volatility was far worse than expected. The sense of underperformance was far worse. It completely changed the game. So a hugely reflective moment related to the financial crisis. The last point's interesting though. So beyond these kind of shock comments, is that if they need to, the Fed will drop cash out of helicopters to keep the economy going. Now note the date, January 09. If you really believed in that and then you invested from January 09 in the stock market, how well would you have done? Extremely well. So the view is whether it's right or whether it's wrong from the investment side, it's a case of what are the factors that are likely to shape investments and what's the outlook for investments. And in January 09, 2008 was a disaster. But in 09 and in 10, and what we've seen in recent years is that exactly did happen. The Fed would drop cash out of helicopters if they needed to. And we've seen that through the quantitative easing factors, which have been supportive for risk assets. So what worried me in 2006 and in early 2007? Well, leverage, first of all, personal leverage, corporate leverage, government leverage. Clearly a number of concerns relating to the amount of indebtedness in the housing sector. Corporate leverage was getting to all-time highs, while spreads were very tight, and government leverage was rising. The risk-free thing is something which I never really believed in. Risk-free, what is risk-free? Well, there's credit risk, there's interest rate risk. There's plenty of risk relating to all sovereign debt, including the US sovereign risk-free, and certainly on the likes of, say, peripheral European debt as well. All that leverage was rising at the same time that people were actually buying. So the risks were going higher, but the prices were going higher as well. So pretty much inconsistent, but that's what was happening. That was in many ways irrational. And when you get a more of a rational behavior of fundamental risks rising, but actually the price also rising, there's something going wrong. At the same time, shareholders from corporations always demanding more and more returns, never being happy with saying actually our returns are a bit less than last year. It's a key watch point. And investors also looking for higher returns as well. That also is a concerning point happening back then. The demand for structured assets was rising, but actually the credit analysis was relatively low. I mentioned that AAA assets, people would buy them because they're AAA rather than really investing. What are the real probabilities of getting the money back? Where are the risks in these structures? So some of the analysis was getting somewhat superficial. Housing affordability, more concerning. Banks willing to throw money. I'm Irish, as I said. Ireland was probably the basket case around the world of people just keep on investing. What goes up has got to continue to go up, taking it as a source of national pride almost that housing is doing well, but actually being oblivious to the fact that the ratio of your income to your mortgage payment is getting stretched and stretched and stretched, and ultimately something is going to happen. And then the last one is you're working in the investment side. Beyond the big numbers which are going out of some of the leverage statistics, investments is about the prices. And when you see a shocking change in some of the prices of some securities, something seriously going wrong. And I was working in late 2006 related to securitized debt, holding some investments, AAA investments, investment grade assets, typically priced at par. And I get a market valuation for some housing related debt, 30 cents in the dollar, not 70%. Now the worst this type of investment would ever do before would be maybe lose 1% or 2%. Just like that, 70% loss in one investment. And then another one comes in. And then the next month it's a 75% loss in total. That was back in late 2006. We know what happened in 2007 and 2008. So the tick-tock, the clock was ticking. There was serious concerns going through. These were some of the key points that I observed back then and some of the direct experiences. So how I positioned the portfolios for the global financial crisis within Russell in our global bond funds is that I still had an overweight towards credit. I wasn't underweight. I wasn't that clever. But I was cautious about it, so I had a cautious overweight to credit at the early stages. I made sure there was an allocation towards some non-credit sectors, such as just government bonds, which if government bonds were to rally in a crisis, the expectation is performance portfolio would be improved. However, I did a gradual build-up in credit spreads, just because they got cheap initially. I didn't just weigh in straight away. It was a gradual build-up. And then I made my move in July 2009, that when credit spreads really got attractive, I made a bigger allocation towards non-agency mortgage securities, which thankfully subsequently did well. So that was back then. What worries me now? Well, it appears a Fed-fueled rally. I think the word appears is kind of a compliance sanitized word. I believe it's a Fed-fueled rally. I think it's pretty obvious out there. You saw that earlier chart. As soon as the Fed gets involved, the stock market goes up. It's very related. As soon as the Fed feels like or makes some comments about tapering, you're seeing some concerns relating to the stock market. So pure market forces are not in play. That's a big concerning point. Demand and supply, if there's thousands of demand, thousands of supply, even itself out, fair market price, you get comfortable. If you've got the Fed interfering, it's a case of, well, what happens next to the Fed action? That's likely to impact on pricing. So that's a big concern. The Fed tapering risk all related to that. And then you've got these bond vigilantes out there. Who are these people? People like hedge funds ready to short US Treasuries, on the sidelines, ready to pounce, sniffing blood right now that Treasuries are relatively low, Treasury yields could go up higher. Now that does happen. These bond vigilantes who can short Treasuries will make a ton of money against US Treasuries. They're ready to pounce, and that is a concern. The sovereign risk is still there. It's there in peripheral Europe, it's there across the world, it's there in the US as well. And what we're seeing is the increased connection between bank risk and sovereign risk. Ideally, you'd separate them out. Depositors would put their money with the banks, and the banks would invest it anywhere else apart from a sovereign that they're in. But they don't. Because of liquidity, because of the way traditional investments build up, is that banks typically will invest their money with the sovereign which they're in. So US banks will invest in US Treasuries, Italian banks will invest in Italian government debt, Spanish banks will invest in Spanish debt. So you can see the contagion risk which is still there, and that's a big concerning point. Shock events and contagion risk. I'd love to come up here and say, this is what's going to happen next, this is what the financial crisis, this is the date it's going to happen, and this is what you need to invest in. There's no way I can do it. The one thing about financial crisis is that they typically will come up from somewhere that you weren't really expecting them, or very few people will be able to predict them. And that's a really concerning point, because most people in the market have a sense of belief that they know what's going to happen. The reality is they're nearly always wrong. Improved risk management. So following the financial crisis, the message was, well, something went wrong, you've got to have improved risk management. What that gets to is not to take too much of a position in one area. If it starts to sell down or lose money, to then sell it. These are traditional risk management systems which have been developed since the financial crisis, typically VAR-based systems. But what it means is that if something starts to sell, more and more people will sell, everybody sells. You can imagine what happens to prices. And the improved regulation affecting the liquidity in the markets. The concern post the financial crisis is that banks were the bad guys, that there was a lot of risk held within banks, and this is a bad thing. And there's some arguments to that. However, the regulation since then has caused bank balance sheets to reduce, and the amount of what I call it inventory or fixed income inventory that they could hold would be reduced. What I'm explaining here is that if the banks can have smaller balance sheets and if they can hold less assets, it means there's less liquidity in the markets. They're more like brokers rather than holding risk on their balance sheet, which can support greater liquidity. It's a watch point, it's a concerning point. It means that if there's less buyers in the market, and when you get a stress event, if you've got no buyers, then what happens to prices? So how I'm currently positioned right now? Well, I've got a low overweight towards credit. I still like credit, however, it's a low overweight. I am concerned relating to some of the factors which are out there affecting the overall market, both in terms of the big fundamental risks going on, but also relating to where the price is. Prices have done very well for risk on assets, such as equities and credit, so I'm cautious, so I've got a low overweight. My highest conviction is in non-agency mortgage-backed securities, so you have to have a highest conviction somewhere. That's where it is. I like it just in terms of where the housing sector in the US is improving, in terms of where the yields you can obtain in this relative momentum strategy market at the moment of buying risk on assets. That seems to do well. However, I'm reducing the size of the position. I'm cautious. It's not a case of chasing yield just for yield's sake. Interest rate risk, got an underweight to duration. That means I believe that interest rates would rise, but it's a modest one. Not a huge believer that interest rates are going to spike through. Generally, I don't believe it's going to be like a 1994 situation because of the extent of the amount of indebtedness within the system at the moment. I think the Fed has to be very cautious there. Against that, the case is how effective could they be? If they're not effective and if the bond vigilantes come through, for sure there's potential risk of treasury yields rising. But I think the incentive for the Fed to get it right is huge, and they've got pretty big firepower and they're using their balance sheet. So I think that in itself should be pretty supportive of treasuries. However, it's clearly a key watch point. More global exposures. So rather than just relying on the US as a concentrated market, there's other opportunities elsewhere on a more global basis. More focus on liquid strategies. In the financial crisis, there were a lot of illiquid securities, a lot of illiquid sectors. It meant that these sectors underperformed when there was a lot of stress, but focus on more liquidity. And then diversification. Can't say the point enough, whether it's diversifying in different strategies, whether it's different sectors. Very important. Markets are challenging. There's no one clear winner out there, but rather than just relying on one investment bet, you diversify it across a number of different areas. You tend to spread out your exposures more and reduce some of your volatility. So that's the risks and the views that I have at the moment. Right now, real quotes from conversations I have with other fixed income managers. Interesting quotes. I think they're reflective of my views on the market and what you should be mindful of. The first one is time and financing have been great healers. Well, it's kind of weak, isn't it? It's like just time. Just because things have passed, things are better. And financing from the Fed, that's nice. That's made things better as well. So they're not very strong arguments. They're not getting into the fundamental side of economies getting stronger or more diverse, earnings getting better. But instead, the problem's just passed. We got tired of that. Now things have got better. And hey, it's cheap financing, so it's a good thing. And they've been supportive of risk on assets, particularly equity markets. Next one is that the Fed is reliquefying the housing market and financial markets. Again, from within the markets, there's a very strong view that it's the Fed that's driving the improvement within the housing market, and it's the Fed that's driving the financial markets. So if the Fed pulls out, that's a key watch point. The Fed may support Europe. It's going global. The Fed is aware that the European contagion risk, and there's views that the Fed, through any potentially direct action or indirect action through its QE, for example, in the US, could be supportive of Europe. And the markets are tired of the European story to some extent. Sometimes you get fatigue in financial markets. There can be a concern point, concern, there can be risk, and then all of a sudden it's like you've heard the story so many times, you get a little tired with it, there've been some improvements, and then if there's some improvements, you feel that the story is over and you move on. But the next point is that Cyprus was a shocker. It absolutely was a shocker. One was a shocker because it's interesting you compare that versus the markets being tired. The market's somewhat tired with the European situation, but then Cyprus occurs. In other words, we're not out of the woods. But also was a shocker in terms of central bank activity, really destroying the value money, destroying the confidence in the markets, really destroying what Europe was trying to build up. So it goes to show, and it's a key point, is that policy really has a lot of risk relating to it, and that's something from an investment perspective that I'm highly mindful of. The last point here is that the sovereign balance sheet is full now. They just have to get risk down, and so fiscal drag is coming. What we're seeing is that the leverage has been pretty much at an all-time high. Governments are concerned relating to that to the extent that they don't want to lose their AAA ratings. They want to keep their cost of financing lower. They're shocked with regards to how bond vigilantes can attack countries such as Greece and Spain and Italy and Ireland as well. And with that, they're trying to protect their own balance sheets. So they're protecting their credit rating. How they do so, try to get some of the leverage down and also try to improve some of their deficits. So the likes of austerity could be coming through as well. So it's within that background, you can see that equity markets are doing well, treasury yields are coming down low. There's several points out there to be mindful of, and that's really where I'm looking at the financial markets right now. So I'll pass it over to Steve at this stage, and then very happy for any questions afterwards. Yeah, thank you.
Okay, well, I'll be covering a bit of the same material today as well as tonight, but for this audience, I'll be handing over to some of the modelling systems I use to try to show where my analysis comes from. I've got more time. How long do I actually have, Alan? How long do we have? About Okay, that's good. So you're going to be seeing the screen's going to be flying past your eyes a bit occasionally, so I apologise for that in advance. Well, let's get going. Now, so take it most people in this room have done economics. Who hasn't done an economics degree, hasn't studied economics at all? Come on, Steve, cut it out. Those who haven't. Okay, some, okay. Well, the bizarre thing for anybody who hasn't done economics is the statement I've got as a summary at the beginning of this slide, that economists ignore banks, debt and money. And most people who haven't done economics would think economists have to be experts about money. And of course that means they've got to know about banks and debt and so on. And they don't realise, if you do an economics degree, one of the first things they teach you, what they call the veil of money, is a veil over barter. And now all that money does is make it easier for us to exchange widgets with each other. And therefore money is just a transparent veil. Get rid of it, you see the system more clearly, and actually ignore banks, debt and money in their modelling. And normally when I make this critique, I'm attacking neoclassical economics, which is the dominant sect in economics. I regard economics as more a set of competing religions than a true science in any sense at all. But that's not just, it isn't just the neoclassicals who are the Krugmans to the left-wing extreme to the Cochranes at the right-wing extreme. It isn't just them. It's also a lot of Keynesian economists, including Keynes. And if you look at the general theory and try to find, you will find certainly plenty of arguments about money, but when it comes to how money is actually created, this was Keynes in the preface, saying that technical monetary details fall into the background and you just end up with looking at supply and demand with the knowledge that a monetary economy is one where our views about the future affect what we do now. And that really, there was not the technical detail in money that there should have been, in my opinion, in the general theory. So even though I knock neoclassical theories, they're just continuing the same non-monetary trend. And if you look at why they say you don't need to think about money, what they call new Keynesian. Now, new Keynesian theory is, in my opinion, neither new nor Keynesian. Okay, but that's what they call themselves. I think they should be called actually old Hicksian. But they ignore money and debt as well. And this is Bernanke talking about why Irving Fisher's debt deflation theory of Great Depressions was not taken seriously by neoclassical economists, who said because of the counter-argument that debt deflation involves no more than a redistribution from one group, debtors, to another group, creditors. Now, it's news to me that people who go bankrupt actually pay their debts back. Okay, but nonetheless, that's how he put it across, and said that without huge differences between debtors and creditors, pure redistributions should have no impact. So they simply see debt as a transfer from somebody who's saving money to somebody who's borrowing money, and one person, the saver's capacity to spend goes down, the borrower's capacity to spend goes up, and the two cancel each other out. That's the mindset they have for why money doesn't matter. And Krugman is the same, talking in his book about endless depression now. I'm taking a few words out to summarise the points here. I'd really argue I've distorted his view, but largely this is the argument he's making. The overall level of private debt doesn't matter except during what he calls the liquidity trap. The one person's liability is another person's asset. Therefore, we can forget about the level of debt or changes in the level of debt when analysing the economy, except during unusual circumstances like now when you have a zero rate of interest. Now, my position is that money is essential, and not just in the way that Keynes covered it, but you've got to cover the technical details of money. And to pull apart the neoclassical argument that you don't need to worry about it, it is true by definition, the way accounting works, that assets are equal to liabilities plus equity. It's what's called the fundamental law of accounting. The question is, what's money? And this is not addressed by neoclassical theory in any sound way. The best arguments for this came out of a European group called the Circuitous School, an academic from the University of Rome called Augusto Graziani, wonderful name. And Augusto is one of the few human beings I've ever heard who can speak in perfectly formed paragraphs in English. His first language is Italian, brilliant speaker. But he said, what essentially is money? Well, he said it has to be a valueless token. If it's actually a commodity, if we imagine we sort of, do exchange by swapping bottles of mineral water with each other, well, this is something you're actually making. You can manufacture it yourself if you want to. So he said to treat money as a commodity is not really treating money at all. You're just making a barter a commodity where you're saying one of the barter objects is the exchange token, but it's not really a monetary economy. It's another form of barter. So it has to be valueless, which is a piece of paper, which we accept in transactions, fundamentally is. But it's also got to be accepted as full payment. Now, I could, of course, say to Alan here that, that can you lend me some money? I'll buy something with it. And Alan will say, here's the money, but you owe me. Well, there's still a credit relationship between us. I've bought a commodity, but I've still got a debt relationship to Alan. So there has to be, it has to be accepted in full payment. When I hand over a piece of paper to buy a commodity of Steve here, then that is actually, Steve accepted as full payment if I bought whatever your lunch was off you, that's there's no credit relationship left between us when I buy it with money. And the third point is that the issuer of money can't get infinite rights to buy out of the capacity that they can create that money. And Graziani said, putting those three together, the only way you can satisfy that is that money is actually the promises to pay of a third agent. Money fundamentally is swapping the bank's promise to pay between the creditor and the debtor. He said, so if you make a payment by cheque or by an FPOS transaction or anything else like that, there's no debt or credit relationship between the buyer and the seller, but one has become a creditor of the bank and the other has become a debtor of the same bank. So promises to pay by the banking sector are what money is, and that means what we're actually trading in a monetary economy are the liabilities of the banking sector. That's what money is, fundamentally. So that in turn means that we buy by exchanging the liabilities of the banking sector. So if the banking sector's assets and liabilities grow, so does the amount of money in the economy. And that growth of the amount of money in the economy actually boosts spending power. Now that's the essence of the post-Keynesian approach to endogenous money. The whole community of people making this case. I'm far from being the only person, but probably the leading individual to start this analysis was Basil Moore, but there's a whole group of post-Keynesian economists, varying elements of the elephant we grab hold of to describe the nature of a credit economy. But this is the fundamental essence of it, that the financial sector endogenously expands the amount of money in existence by equally expanding the asset side, which is the loans, and the deposit side, which are its liabilities. Now, that's essentially different to how so-called new Keynesians think about it with the loanable funds idea. And this is a quote from Krugman now. He's saying, when debt is rising, it's not the economy as a whole borrowing more money. It's a case of less patient people borrowing from more patient people. Now, just check this out, by the way. I love this extent to which neoclassical economics, which emphasises when they teach students that they're value-free, uses such pejorative language. Patient, impatient, good patient person, naughty impatient person. Yeah? Turns up all the time. So they say that the limitation to borrowing is the concern that the patient lenders have that the impatient ones will be able to repay their debts. That's the only measure we need to worry about. Now, that's wrong. When you have an increase in borrowing, it is the economy as a whole borrowing more money, because the economy is borrowing money from the banking sector, and the banking sector is creating additional money by the act of lending. And that I can now contrast using a software package I've designed with the help of money from the Institute for New Economic Thinking to try to build a monetary approach to capitalism. Because we have to build a monetary model. We have to understand the economy as a monetary system. And what I thought I'd do is show what the neoclassical vision looks like in a monetary world. But they don't have a monetary system. Krugman and Eggertson have done a paper which attempts to build a model of, they call it Fisher-Kuh-Minsky model. It ain't anything like what Fisher or Minsky believes, and I know Richard Kuh well enough to know it wouldn't capture his views either, but this is what they see as the way that the economy functions. So what they have, and this is showing the financial accounting side of my software package, Minsky, is that this is a banking system now, and the patient agent has money, the impatient agent has no money, and what is actually going on is that there's lending from the patient agent to the impatient agent. Now, this is following all the principles of double-entry bookkeeping. So the asset side, which is the reserves of the banking sector in this system, because the bank's doing no lending in the loanable funds vision, is a positive number. You'll notice we've got plus 100. I hope you can see that text at the back of the room. Can you see the text well? Or yeah, pardon me being a bit challenging with screen size there, but that's the story. Okay, well, that's shown as plus 100, but that's looking at the assets of the banking sector. Now, the liabilities are shown as minus, okay, because your assets are a positive for you, your liabilities are a negative. Those liabilities, so for you as the patient agent has $100 or $100 million in the system, but it's shown as minus 100 from the bank's point of view, and therefore the overall sum over here, the row sum over there, is shown as 0. And that rule is used all the way down, so you actually get accurate accounting. If I actually had the software package running, and I do have it in the background, if I change one of those numbers, do you see the row sum being anything other than 0, that would be an error. So this program itself checks to make sure you don't make a mistake. Now, the lending is seen as a transfer from the patient agent to the inpatient agent, and that's shown as a positive entry in the patient agent's account and a negative in the inpatient. What that means is, from the point of view of the bank's point of view, the bank's liability to the patient agent's gone down because some of the money from the patient agent has been transferred to the inpatient agent, and the bank's liability to the inpatient agent has gone up. Okay, that's what's going on there. So that's lending from the point of view of the loanable funds model shown in Minsky. And then there's other activities I'll talk about in a moment further down there. So this column, when you add up all the entries that are going on there, that generates a dynamic model. And I'm going into a bit more detail than I'll cover tonight on the nature of the logic here. But that's what lets me to derive a model of financial flows. And then using that, I build a model of the overall economy. So I'm going to use that to build loanable funds. And what I get as a complete model, and I'll bring it up on screen in a moment, looks like this. And if the neoclassicals were right, they argue you can ignore the technical aspects of money. And if they were right, this is what lending is right, they'd be correct. And I'll show you with a simulation in a moment. Because if I change how fast the patient agent lends and how fast the inpatient agent repays it and so on, it doesn't have any effect on the economy at all. So let's see if I can bring that up on screen. So I think I've got it running back here. Let's see. Okay. It looks a bit busy, doesn't it? Okay. This object down here is my table of what's happening in the bank. And again, we haven't yet got the capacity to expand the scale, the size of the screen there, but I'll show you, I'll make a mistake up here. I'll change that minus 100, minus 150, and you'll notice over here on the row sum, and that shows up as minus 50, telling me I've made a mistake. Okay, so the software making sure that errors aren't made. Whoops, hang on. You can still make an error even though the program's attempt to stop you. Okay, back to correct again. So what I've got happening here is lending from the patient agent to the inpatient agent, and repayment back in the other direction, payment of interest based on the amount of debt that's outstanding, and then what's actually in my model, the inpatient agent is the firm sector, who wants the money to hire workers and then flogs the goods to workers who buy consume and to the patient agent who consumes. Now, if I run this model, I've now got the capacity over here to change how fast the patient agent lends. So I can make it a very slow or very fast rate of lending, and I can do the same with the rate of repayment. What I want you to watch is down here what happened to GDP and wages. At the moment, I've got no lending going on at all, but in fact, the patient agent has to consume. So what happens over time, the amount of money in the patient agent's account disappears completely, and the patient gets the lot. What happens if I change how far? Notice GDP is running out to of the order of about 300 units, or $300 million a year, or something like that in the system there. If I drastically start the system over again, and then drastically change how fast the lending occurs, notice a bit of a kink there? But look where it's settling down to again. And if I change the rate of repayment drastically, trying to grab that, okay. Bit of a dip, but it recovers again, okay. And notice overall the amount of money, this is over here in this chart I'm now pointing out, I hope you can see the cursor there, flatlining, changing the amount of lending between patient and patient, doesn't change the amount of money in circulation at all. And drastic changes in lending and repayment doesn't change the outcome all that much. You can now see that little dip that I generated by a drastic change in the parameters of the system. So that's the vision they have of how lending operates. But what about if lending is really the way we know it is, which is banks lending to non-banks? Well, I've modeled that I get only one substantive difference to the model I've shown you beforehand, and that's that lending is now going to occur on the asset side of the bank's ledger. So now I've got lend and minus lend over there, but it's happening between assets and liabilities on the banking sector. So the assets grow and the liabilities also grow. Loanable funds has it all happening on the liability side only. Now we know that's not the reality because we have a little thing called the flow of funds statement by the Federal Reserve that shows on table L101, I think it is, the level of bank lending. Okay, it does change. So we know the lending is not all on the liability side. It happens on the asset side of the banking ledger. Now you put that together, and I think I've got endogenous running over here. Let's see. That's it. Again, very busy. Now notice the GDP and wages down here and the amount of money over here. Run this system, and if I change, whoops, how fast lending occurs, by sliding that over here, how long it takes to occur, or make lending much more rapid, or change how fast repayment occurs, or bring that right back, I have a drastic effect on the economy and I change the amount of money in the system. So that's the reality of the difference between the two visions of how capitalism operates. And it's easy to show that when you think in a monetary way, which is why I'm building this software to make it feasible for economists to do this. I know there's no chance of converting the old generation, okay? Despite the financial crisis, despite the mess they got us into by not seeing it coming, they still believe the same stuff. The resistance to change is phenomenal, as anybody who works as a critic of conventional economic theory in the profession knows. So we've got to get the young, and I think we've got to wait for another collapse. Okay, they've got to get it wrong twice, which is what they did during the Great Depression. Now, they didn't see the Great Depression coming either. They went for liquidation back in that stage, and then slowly went to the New Deal change. Only when they fell back, then they thought they were out of it by 35 because unemployment had dropped from 25% to 11. Went back for austerity again, and unemployment rose from 11% to 20% again. And then the general theory came out in 36, 37, and at that stage I think it was total despair in the economic community of its day, and Keynes swept the field. Well, I think we have to rely upon a similar type of dynamic, and let's hope that the post-Keynesian community can keep the momentum going, which didn't happen with Keynes, of course. Unfortunately, he got undermined by Hicks. So that's the foundation I use for a monetary way of looking at the world. But this is all theoretical so far. What about how does this relate to the empirical data we actually see? And I start from something which actually puts me in conflict with a lot of my post-Keynesian colleagues as well, because I argue we've got to redefine aggregate demand as well as redefine the economics to be monetary. Once you do that and you acknowledge the role of endogenous generation of money by the banking sector, then aggregate demand is not just income. The conventional view that you get out of both post-Keynesians as well as neoclassicals is that aggregate demand equals income. It's something we've been working with for 70 years. And aggregate supply is just thinking of goods and services and leaves out the asset market, leaves out finance. My approach is to say that aggregate demand is income plus the change in debt. And I get accused of double counting by lots of people, including a lot of post-Keynesian economists. And aggregate supply is goods and services plus the net turnover in the asset markets. Now, I've gone back in the literature and seen that I saw the argument first in the literature, and often you can have a blind spot if you read a particular book like the General Theory. If you see a neoclassical read the General Theory, somehow they see Leon Walras in there, And one of my best mates, Rod O'Donnell, who's a professor of economics down in Australia, and Rod and I have been colleagues and fighters against conventional economic theory for 40 years now. Rod once gave a paper at a seminar in Australia. We told the neoclassical, he said, "Don't read Minsky." He said, "You'll read Minsky, you'll see Walras in there." And they do. If you take a look at how Eggleston and Krugman have tried to model Minsky, it's Walras with curly bits. So the argument I'm making here I found in Schumpeter, Minsky and Keynes. And even though I'm accused of double counting, I want to show that's not the case. Now, the reason it's seen as double counting is when you look at recorded income and recorded expenditure, they are identical. And people therefore think I'm making a mistake to say aggregate demand is income plus change in debt, because they say that change in debt becomes somebody's income, therefore I'm double counting it when I put it together in that way. No, I'm not. What I'm doing is identifying it as a second source of spending power in addition to earned income. And this little graph drawn by my mathematical colleague Matthias Grasselli at the Fields Institute gives the argument as to why. What it's showing there is a flow of expenditure coming out of existing money, turnover existing stock of money in wages and incomes, and that's income at time t, which we can call ex ante, income before the event. Then somebody borrows money and spends that into the economy, and that's expenditure at time t. So before the change in debt, income and expenditure are identical. After the change in debt, income and expenditure are identical. At the point, they differ. And then the economy goes on from there. And if you record it, what you're doing is looking backwards. Okay? And if you integrate over that period of time, which you need to do to get the measurement, you'll find they're identical. But in fact, in the causal sense, expenditure is income before there's an injection of debt plus the injection of debt. And that's completely consistent with sectoral balances. I've got to get this through the post-Keynesian community as well. I'm going to try that at a seminar at Harvard coming up in a couple of weeks' time. So it's quite consistent to say, yes, sectoral balances apply when you measure, but effective demand exceeds income at the same time. So it's not a fallacious argument. It's quite genuine. So now what I want to show is how that feeds into economic activity and why that vision, which I had at a verbal level when the crisis began or before the crisis happened, it took me a while to put it together analytically, how that turns up in looking at the economic data. So with two sources of demand for coming, one from income and the other from borrowing, you also have two categories of supply, goods and services, which is the normal focus of conventional macro, both neoclassical and post-Keynesian, and finance turnover in the finance markets. You've got to integrate the two. Now, Schumpeter argued that income is mainly spent on consumption, and change in debt is a significant source, not the only one, obviously, because there's retained earnings as well, but a significant source of funds for investment. And Minsky added to that, yes, that also finances speculative behaviour on stock markets and obviously housing markets as well. So putting this in a sense of an equation, you can see wages and profits predominantly going across to finance consumption, and the change in debt financing mainly investment and turnover in asset markets. Now, when you then look at that as an overall sense of financial balance, aggregate demand is income plus the change in debt, and aggregate supply is production of goods and services, expenditure on them, and also expenditure, net expenditure, on goods and on the asset markets. So I call that net asset turnover, and you can break that down into the price level of assets, so pretty much the Dow Jones, the S&P 500, the quantity of shares that exist in circulation at the moment, and the turnover of those assets over a time period. And when you look at in macroeconomics, that means that therefore change in debt is going to be a major determinant of what happens with GDP and therefore employment. But when you look at a change in aggregate demand, that's going to involve change in income plus the acceleration of debt. And so there'll be a relationship between acceleration of debt and many factors, but also particularly change in prices and asset markets. And that, therefore, this perspective lets you explain both the great moderation and also why asset bubbles have to burst. Because nothing, not even the finance sector, can accelerate forever. So let's look at the empirical data now and see how that helps us see what happened with the financial crisis. This is looking, first of all, at private debt, which is the red line, GDP, the dotted line, and government debt, the blue line. Now, it still stuns me that the debate in America, Australia, Europe is all about the blue line and how dangerous that is. They don't pay any attention at all to the red line. It's a bit like, the little blue pill, red pill thing in the Matrix. They're all swallowing the blue pill. They don't realise they're sitting there being ever-ready batteries for the Matrix, which is the finance sector. Let's now put together my argument about aggregate demand being income plus the change in debt. So now what I'm showing is GDP once more, now the black line. The red line is the annual change in private debt, and the blue line is the annual change in public debt. And the dotted line there for begin is the start of the recorded recession, according to the NBER. Gee, notice when the change of debt turns around. Okay, and that's what I was arguing before the crisis began. The crisis will begin when the rate of change of debt slows down. It doesn't need to become negative. It's just slowing down that'll cause the crisis. And to put that together and to add change in debt to GDP, first of all, talk about the level of deleveraging. Here's where the crisis was most severe, because for that 2-year period, the American public, the private sector, it's weird how we say that public is the private sector. Weird one, but English is a strange language. Okay. For that period, the private sector was deleveraging, reducing its debt level. Actually, debt level was falling over that period of time. Now, when I put together GDP plus the change in debt, now you can see when the crisis began and the role of government spending in attenuating that crisis. So you have this period up here where GDP was about 14 trillion, but the increase in debt was about $4 trillion. So total spending by the private sector was about $18.5 trillion. Then you get to the depths of the crisis, the downturn down here. This stage, GDP is still roughly 14 trillion, but the decline in debt's about $2.5 trillion. So you go from being in an $18.5 trillion private sector economy to an $11.5 trillion economy. That's why it was such a severe crisis. That's a huge drop. Now, the government sector meant you went from being roughly 19 trillion to roughly 13 trillion. Still pretty bad, but not as bad as it would have been had the government not done that spending. And I'll show you how this compares to the Great Depression in a moment. Now, again, the neoclassicals argue that change in debt has no macroeconomic impact outside a period where there's zero interest rates, because then you can't get loanable funds to work, because the decline in spending by people who used to be borrowers is not matched by an increase in spending by those who used to be savers. So according to them, there should be no correlation between debt and macroeconomic variables like unemployment, except after the zero lower bound. Well, the zero lower bound began in about 2008 from memory. This is going back to 1970. And that's the correlation between change in debt and the level of unemployment over about pretty close to a 50-year period. That should be zero according to them. Sorry, minus 0.71. Pretty potent correlation. And what you get is because rising debt finances economic activity, you get a negative correlation between the two. And it's a correlation causation argument. Now, if you look at public debt, what you find is, first of all, I'm looking now at a shorter time period again, and the closer I get to the crisis, the bigger the correlation comes between changes in private debt and unemployment, because we've got a high level of private debt. The change in debt each year is a bigger and bigger proportion of total spending. So from 1990 through to now, the correlation between change in private debt and the level of unemployment was minus 0.92. You don't often get correlations that high in economic data, especially when they're supposed to be zero, according to the conventional wisdom. But then rising unemployment causes rising public debt, because an increase in unemployment means there's more welfare payments, less taxation. So you put the correlations together, this is what you see. Between the red line and the blue line, which is unemployment and change in private debt, almost look like a Rorschach plot. Okay? One's the inverse of the other. But public debt follows the pattern of unemployment. So the increase in public debt that everybody's obsessing about now was caused by the crisis. It isn't the cause of the crisis, it's a symptom of the crisis. And were it not there, the crisis would be more severe, as we can see in Europe. Now, this is looking at the second order effect, and I have to admit here that I was a bit of a coward. I knew that this logically applied, that if there was a correlation between change in debt and the level of unemployment, then there should be a correlation between acceleration in debt and change in unemployment. But I didn't look at it because I thought the data simply wouldn't support it. And an English hedge fund employee, Michael Biggs, and Mayer and Peck did it first. So I've got to tip my hat to them, and they saw this information first. The correlation between acceleration of debt and change in unemployment. Now, I've turned the change in unemployment upside down to make the correlation more obvious. But that's over now, again, a 20-year period. And to get a correlation that high between the second differential, effectively, and the first differential of economic data is stunning. That just shows the role that credit plays in driving the capitalist economy. And now let's use the same analysis again to say, yes, we're having a bad crisis in America now, but it's not as bad as the Great Depression. So why is that? It's because of the scale of the government stimulus and how fast it came into operation. Because when the crisis hit, completely blew the economics community out of the water. They had no idea it was coming, except for a large proportion of the post-Keynesian community and quite a few Austrian economists as well. But the conventionals, they thought it was going to be all clear sailing. Their weather forecast was sunny skies forever when this crisis began. So they're completely shocked by it. They went into total panic mode, and they became born-again Keynesians, the biggest stimulus in history. We think the Great Depression was bigger. In fact, when you look at the level of debt finance spending by the government, which therefore increases the amount of money in the economy in the same way that private sector debt spending does, the stimulus this time around was much bigger and much faster than the Great Depression. So here's looking at debt finance spending during the Great Depression from when debt finance spending was the biggest contributor to aggregate demand forward. And it turned out that in 1928, which is year zero on this chart, debt finance spending by the private sector added about 8% to aggregate demand from income alone, from GDP alone. You notice how by 1930 it turned negative. You then had a 2-year period where the rate of deleveraging was so high that the change in debt was subtracting 25% from aggregate demand. Then you get up to a positive period here where people are neither borrowing nor there's no borrowing or reduction in debt going on, and a period of borrowing money once more and then falling back into deleveraging again and then rising once more. That zero line there is where the change in debt is zero. Now I'm going to add over the top of that what the impact of the government spending was. And of course, nothing actually happened for the first couple of years. Then you had a period of a fairly substantial boost where the gap between the two is the impact of government spending at that period. This was 1931. Then the government goes back into austerity again, balancing the books. Really important to get the books balanced. Then finally, this is the New Deal. Okay. And then Roosevelt recession, because the unemployment had fallen to about 11% by 1936. The government, notice the gap here reduces. The government's trying to get back into surplus again. And that's what I think triggered the private sector to start deleveraging once more. And so you had combined reduction in debt by both the private sector and an attempt to do so by the public sector. And that re-triggered the return to the Depression, back to 20% unemployment again. Let's now look at our period, which began in 2008. In 2008, pardon me, I'll just page up here. 2008, the debt finance spending in the economy was equivalent to about 22% of GDP. So you're going to go and see the Great Gatsby pretty soon. Gatsby had nothing on us. Okay, we have far more debt spending this time around than even back then, no matter how great the Gilded Age looks when we look back at it. But you see how rapid the crisis was. We fell from 22% boosted aggregate demand out of the change in debt to the same scale of the Great Depression, 25%. So a huge fall and much faster than the Great Depression. So the sense of panic we had back in 2008 was entirely justified. Why was it not so bad? This is the government's contribution. So even though we think that there's nothing like the Hoover Dam, nothing like the Tennessee electrification program this time around to show what the Obama stimulus was, that's the scale of the Obama stimulus. Pretty much equivalent to 15% of GDP. All this data is coming out of the flow of funds table, by the way. So I'm just showing you, this is data you can actually, straight out of what the Federal Reserve is recording, the government's effective borrowing from the banking sector did to stimulate the economy. So in other ways, you could look at the level of the stimulus and say the budget deficit was quite small, etc., etc. That's the actual scale of the impact on the financial system. What it meant was we're back in a period where the private sector is borrowing money once more, much more rapidly than during the Great Depression. We got to here 4 years after the crisis began. They got there 7 years after. So up in positive territory again, but what's the conversation right now? It's about reducing this gap. Now, if we reduce this gap with the level of debt we're still in, and I'll show you that in a moment, I think we could trigger this again. There's a real danger that the focus on getting the government's books back in balance, as if that's the major crisis, will re-trigger another period of austerity. And this is now, I'm going to have a good go at the neoclassicals, having gone through all this stuff. This is what they thought was happening. in 2007. This just shows how ignorant they were what's going to happen. They thought they were going to have a soft landing in the States, sustained growth and falling unemployment, etc., etc. That's how wrong they were. So we have to have a different way of thinking about the economy. And I've shown you a start of that with the monetary approach that I take. What I want to now show you is applying Minsky, as Minsky actually wrote, and putting Minsky in a monetary complex systems framework, which is the work that I've been doing for the last 20 years. When I wrote my first model of Minsky back in 1995, or actually wrote the paper in 1992, it was published 3 years later. Pardon me, I finished with this particular statement that at the time I thought was a really neat rhetorical flourish, saying that from the perspective of economic theory, the vision that the paper gave of how a capitalist economy behaves shows us we should stop believing that the past will be the future will be a projection of the future. That the chaotic dynamics that the paper generated should warn us against regarding a period of relative tranquility as anything other than the lull before the storm. Well, I got that one righter than I thought, because that's what actually happened. A period of apparent tranquility and then a crisis. So I want to show how we got there. So Minsky's thesis begins with an economy in historical time. And I emphasize both those words there because neither history nor time play a role in neoclassical theory. We've got to bring them both into economics. Pardon me. Since you're talking historical time, there's been a debt-induced recession in the recent past. And Minsky's model starts from the point of view whether you've just come through the crisis and you're starting to recover. And in that situation, because the crisis is so recent, both firms and banks are very conservative about the amount of debt they'll take on. And because they're conservative, the only ones that are put forward for debt finance spending have been worked out, they're going to succeed, most of them. They end up succeeding because of the recovery. And the response of both firms and banks is to think, we were too conservative. If we'd borrowed more money, we would have made a more levered gain. So the accepted level of debt to equity starts to rise, and you start to put a higher valuation on assets. And Minsky's classic phrase, stability is destabilising, part of the Australian spelling there. So you have a period of tranquility causes rising expectations. And for a while that's a good thing because the self-fulfilling side of those expectations mean with a decline in risk aversion there's more investment and the economy grows faster because of that investment. But ultimately you get to what Minsky called the euphoric economy. I'm sure you've experienced that in the finance markets, and I won't accuse you of it, but quite a few of them, euphoria is certainly drug enhanced. Now, you get an increased speculation on asset markets, an expansion of the money supply that makes it easier to finance that, and as I've shown you, the money supply is endogenously capable of growing, the central bank doesn't control it. Riskier investments are made more feasible, asset speculation rises, there's more losses being made because a lot of those investments are bad, and Ponzi financiers turn up who have a cash flow that's less than their debt servicing costs. And they can only profit, they can only survive, in fact, by selling assets in a rising market. And they therefore drive up interest rates because they desperately need to have borrowed money. Otherwise they go bankrupt. Ultimately you get a crisis coming out of that. Some of those conservative projects fail. Other ones become losing money when the firms thought they'd make money out of them. Non-Ponzis are forced to sell assets, and the entry of new sellers into the market floods it, it collapses, and you go back to where you began with a crisis. The Ponzis are the first to fold because their debt servicing costs are greater than their assets. Asset prices collapse, the expansion of the money supply ends, in fact, investment ends, the economy slows down, you're back where you started again. So that's pretty much telling the story from the 1990 through to 2000. But as well as repeating itself once the debt levels fall once more, you also have a tendency for that debt level to ratchet up over time. And you can get to the stage of a final crisis where there's so much debt that the economy can't refinance it. Now, I've built models of that, and I know I'm getting close to time here. I can see some people, some fading and others leaving, so let's roll through it. I had to build this beginning with a cyclical model of the economy, so I couldn't use a neoclassical model. And the best model was built by a guy called Richard Goodman back in the 1960s. And it's a very simple model. It starts by saying the level of output is determined largely by your capital capacity. And the level of output then determines your employment, given labour productivity. That determines the employment rate. And the employment rate plays a large role in determining wages. rate of change of wages. That then determines the wage bill, which determines what profits end up being. And if capitalists invested all their profits, integrate that, you get the rate of change of capital, giving you the level of capital, and you get back to where you started again. And when you model it, you get cycles, you don't get equilibrium. So I took that as a starting place, and I made the model more realistic by adding that firms borrow money to finance investment, and of course have to pay interest on it. So when I put the model together, the sort of behaviour I got, and I'll see if I can bring that up and run it on screen while I go through the rest of the presentation. What you get is cycles that ultimately lead to breakdown. Oh, hang on. Oh, great. I've just accidentally added an extra element there by tapping too close to the run model. Here we go. It's running. Okay. I'll let that run in the background and come back to it. So what I get out of my model, and I'll show you that in a moment, it has two potential equilibria. A good one you'd actually like the economy to end up in, where you have positive wages, positive employment, and finite debt. And a bad one, where you get zero wages, zero employment, and infinite debt. Now, the transition between the two is a bit like falling into a black hole. You don't know whether you've done it until you're there. And once you've got there, you can't escape. So you don't want to have that happen. And the way to destabilise it, to avoid that crisis, is, from Minsky's point of view, government spending. Now, I don't believe it's enough to get out of this crisis. I think we actually need to write off the debt as well, because so much more has been accumulated than would have happened without the Federal Reserve's rescues ever since 1987. But I think we've got probably an extra 150% of debt over what we could have had to start the crisis without government intervention. So in that sense, I'm actually a critic of what the government can do, even though, I'm arguing it can make things better by attenuating these cycles, if it holds the line, if it behaves in a Keynesian fashion all the way through. By rescuing the financial sector rather than rescuing the real economy, it actually made the accumulation of debt far worse than it could have been otherwise. So I think we actually need a debt jubilee to get out of this crisis in the long term. So this is my model run with the government behaving as a classic, genuine Keynesian government, holding the line at a set level of unemployment, spending because when the economy declines, its spending necessarily rises, behaving like an air conditioning unit, effectively. When it gets colder outside, temperature rises. When it gets hotter outside, temperature falls. And that attenuates. And what it gives you is not stability in terms of no cycles, which is the neoclassical vision of stability. What it gives you is permanent cycles, but not breakdown. That's the sort of economy we could be in. We've ended up in one where we've ended up with breakdown because the government has ended up rescuing the financial sector rather than rescuing the real economy. So, in a summary of all this argument, I know I've gone far too quickly and covered far too much material. By the way, back to my model, what's it doing right now? This is looking at a ratio of wages share of output to employment. And if you're looking just at inflation and profit level, everything looks great. That is your process of entering the black hole. I'll come back to that in a short while, and you'll see the spiral getting bigger here, and that's falling into the black hole of too much debt and a total breakdown of the economy. So you've got to include the monetary system. You've got to include banks, debt, and money in how you treat macroeconomics, which is now, I can now make it easy to do using the software package I've designed, which I would love to have other economists start to use. And we've had a bubble caused by excessive debt, by private debt. Ending it involves reducing that private debt. But if we let the usual dynamics go on of liquidation, it could take 20 years to get out of it. And I'll show you a bit of a reason as to that in a moment. So we have to change how we think about macroeconomics, and we have to reduce the level of private debt by direct policy. Having made a mistake by letting the private sector create too much debt, we now need to cancel it by a matching mistake of the Federal Reserve being able to create money but putting it in our pockets rather than the pockets of the banks. And if we don't do it, how long could this crisis go on for? Well, this is now looking at the level of private debt to GDP over the last 80, 90 years for America. What I've done is extrapolate forward the rate of deleveraging that began in 2009. And if that process was all we relied upon, it could take 20 years to get back to the level America had of private debt back in the 60s and 70s, or 50s and 60s, when you could really say the money that had been borrowed was used for productive purposes rather than Ponzi speculation. Now, Japan has done it for 20 years and remained together because it's such a cohesive society. I don't think America could do that. So I think we're going to see occasional revivals, but generally a tendency towards this sort of crisis, and we can't let that happen with American society. I'll leave it at that. Thank you.
Okay, we have a little time for questions and answers. Mike's here, but if you just want to ask from your seat, you'll have the direct your question to one of the panelists. Restate the question.
Okay. Is there a microphone out there, or talk loudly? Okay.
Your microphone's up here if you need it.
Okay. Yeah.
The reserves on the Fed balance, do they follow borrowing or do they lead it?
They follow borrowing. That's actually one thing I've done, so I can find where I've got that little model here. I've done a bit of a model of QE. I actually got asked to go on John Colson's show. I spoke at it yesterday. I'm speaking at it again tomorrow. And he said he wants to talk about QE tomorrow. So I thought I'd do a bit of analysis of QE. Would that be helpful to look at that?
Yeah.
Okay, let's just take a look at it. Let's bring it up here. What I've got here is a couple of tables that model what the government's doing at QE. And quantitative easing involves effectively giving money to the banks. Okay, you're buying bonds off the banks. QE is not a case of giving money to Steve Roth or anybody else in the audience. Pardon? Given reserves. Yeah, they're buying bonds like mortgage-backed securities, long-dated private bonds, as well as buying reserve bonds off the banks at a rate of $85 billion a month. So that's the flow I've got showing of QE, which effectively I'm showing going from the Fed's capacity to create money going across into the reserves of the banking sector. Now, from the sense of the private banking sector, pardon me, pressed the wrong button. Come on, here we go. Okay. So I can get them both on screen. I hope you can see those reasonably from the back of the room. So QE ends up as shown as a minus QE on the reserve accounts over here, because that's looking at the reserves of the private banks as a liability to the central bank. But it becomes a plus QE from the bank's point of view. They've got extra reserves over here. And they then, to balance the accounting over here, to get that row sum to zero, I have to show that they've got a matching liability to match that asset. And the matching liability is the fact they've actually obligated to buy those bonds back off the reserve at some time in the future. Not a specified time anymore. You know what are called repo agreements? Who hasn't heard of a repo? Okay. A repo is a repurchase agreement. You sell something to somebody with the agreement to buy it back at a later date with a different price, and that's a large part of how liquidity is maintained on a normal basis in the way the Federal Reserve operates. But with QE, they're buying bonds and they're saying, we're going to hang on to them for a while. It's not the return in 7 days routine, but it's maybe 3 or 4 years until they decide to unwind those positions. So the asset of the QE is matched by a minus QE for this one account I'm calling a repo account. Now that's not part of the money supply. Okay? To actually get that into the money supply, it's got to get across to the deposits of the public or to the equity of the banks somehow. So what I then show is, well, let's imagine the banks lend from this repo account to the public. So I'm showing plus lend here and minus lend here. So the money's turned up in deposit accounts of the public. But the banks haven't yet recorded that they've lent the money. That they've got to record they've lent the money. What do? That's minus lend on the repo account and plus lend on their loans, which cancels out any effect from the repo on the amount of money in the repo account. So they might have well have just lent straight to the public. QE is irrelevant for lending to the public unless it makes the banks want to lend more by changing the margin between their cost of funds and what they get for lending the money out, unless it makes the public more willing to borrow money. So it can't have a quantitative effect on the amount of money in circulation. And I'm very confident that Bernanke knows that. Okay? I'm not confident that he knows much more about the nature of endogenous money. It's ignorance in that is rife throughout the new Keynesian group. But he does know he's not creating more money. What he does believe is making more attractive for the banks to lend, more attractive for the public to borrow and spend, and he thinks they're stimulating spending. That's the only effect, quantitative effect. The effect that QE has is not quantitative but qualitative, changing the price margin. Now, what I then show is one way that you can actually get money from the repo into the private sector, and that's if the banks buy shares. Because if they buy shares, they're using repo money, which they're paying a certain amount of interest on that to the Federal Reserve, because since the Fed's bought the bonds off them, they've got to pay interest, I imagine, to the Federal Reserve for those bonds. It's not like the usual repo agreement. They could buy shares with them, which would drive up the price of shares, which is what you're showing in your analysis there. Equally, they can sell shares at a later stage, pay the money back if they need to. So the money lands, the only way directly that the money can get into the real economy and actually cause a growth in the money supply is through Wall Street, not through Main Street. And this has been Michael Hudson's point for a long, long time. Ben Bernanke's helicopter lands on Wall Street, not Main Street. And this is showing it using Minsky as part of the logic. Or the banks are going to make a margin ultimately on the repo trade they've got going with the Federal Reserve. When it's unwound, there will be an equity gain for the banks. So the total effect of the QE on the money supply will be the net speculation the banks are doing on the stock markets, net buying, which I think we're clearly seeing in the data, and whatever they make in a repo margin, which they may have already included in part of their accounts. But as soon as QE is unwound, the banks may be forced to get out of the market again. So I think part of the argument that the QE has driven up the markets, and when QE unwinds, it'll bring the market down, is logically correct. Yeah.
If the bond vigilantes are about to house, you tend to buy tips.
The question gets to the fund vigilantes about to bounce, so a good time to buy tips. It depends. The fund vigilantes are on standby, they're looking for the Fed action, they're looking for that tapering. If they sense that the Fed is anyway weak, you've got the change of guard possibly with Bernanke, you've got dissenting voices, it's brewing, you see Treasury yields starting to rise. Something seems to be brewing in that area. The fund vigilantes are ready to put on their short position on Treasuries, and they really feel that it's cracked. So from an investment perspective, it's short Treasuries.
Oh, they're
shorting Treasuries, hoping that Treasury yields would rise. They would have made money on that. So the more direct way the bond vigilantes would be to short Treasuries rather than tips. Tips really an expectation on inflation. It's not really an inflation expectation of where tips would go. The more direct way would be to sell Treasuries or to short Treasuries and gain if there's a price appreciation.
Yeah. Well, I might say there, I think I'm more expecting bond vigilantes with private bonds rather than government ones, but the government can set the rate on its short-term bonds very effectively, not in the long term, obviously, but certainly on the short term. So those mortgage-backed securities could be slaughtered on the way out. I'd be more worried about that, and also see more possibility for laying the market down on those rather than government securities. Yeah.
I guess on the bond vigilantes, haven't they lost a lot of money in the past few years already? That actually that's not money.
Yeah.
And then, well, if I can ask this second question.
Yeah.
Sure, yeah. Have they lost? They certainly have lost money. Bond vigilantes were in the belief, as loads of investors were, that surely yields are pretty low, and surely yields will have to rise. And people somewhat dismissed that the Fed really could get down Treasury yields. So the majority of the market, from a speculative perspective, have been wrong, but they underestimated the power of the Fed. The Fed has come in a lot stronger than expected and really controlled that price. They've actually been very successful in getting that level down and at a low level. And you've seen recently, when there's some concern or some dissenting voices about QE, or you're seeing a more positive economic number coming out, or you're seeing that left tail risk from Europe going away, you're starting to see Treasury levels rise, but it tended to be maxed out at a level of 10-year Treasuries of about 2.05%. We've seen that level resisted a number of times. It's resisted right now. See where it goes. But right now there seems to be a pressure there that ultimately the Fed has been successful in keeping Treasury yields down. So the vigilantes believing that it will go up so far have been wrong. But the next wave really is coming through is the issue of Could the Fed policy change? Could Bernanke change? Tapering probably is likely to come sooner than expected. And the belief is that treasuries could rise significantly. So my belief is that that's not likely to happen. I think the Fed, given the extent and the stock of debt out there, is still likely to be pretty successful in keeping treasury yields down. But that's where the dynamic is going.
Because I think since they've now got such large holdings of non-government debt, then I think the action is going to be on that side, private debt bonds, rather than on the government ones. Yeah.
So my main question is, I'm trying to understand the fundamental difference between, let's say, the Keynesian right now and Minsky in terms of the grip of what should be done, because it appears that you actually agree on a lot of things.
Yeah.
Fiscal stimulus would be the thing you're doing now, the Obama stimulus is successful across the land, it's more that QE has been better than nothing, but I haven't, that that's not the optimal policy. And also, my sense is that Keynesians are interested in, helping the private, how to say, there's a huge problem in the kind of leverage, and we should be providing relief to the private sector, the homeowners.
Yeah. Okay. I got to repeat that because I'm recording this for a YouTube. So, obviously, I agree with a lot of, say, Krugman's analysis about needing to run a government stimulus and so on. So, where I differ. The way I differ is twofold. First of all, I don't believe the government stimulus is enough. I believe we also have to write off private debt. And because you have an irony of honouring debt that's dishonourable. Okay? The banks should never have been allowed to create the debt, particularly that financed the subprime. That was sheer nonsense that they did that. And there's also a huge amount of the debt that was accumulated during the dot-com bubble, which should have been written off as well. So there's a lot of debt we're trying to service that should actually be written off. Now, the trouble is the banks have also securitized. Another catastrophe with letting banks securitize debt. The originate and distribute model was always going to be a disaster, particularly in America. So having done that, you have a problem that, of course, the public has bought debt off the banks, believing that they've bought AAA. A line I've coined with on the Max Kaiser show once is this AAA or can I trust it? Now, you therefore have to, when you can't just write the debt off, because if you did that, you'd hit people they'd save money, hit 401k accounts, hit pension funds, hit councils, all sorts of things. So you have to find a way of reducing debt while neutralising the impact between people who are debtors to the banks and people who have bought debt off the banks and believe they're asset owners. So my suggestion, I call a modern debt jubilee, and that is to use the power of the Federal Reserve to create money not through a QE type process, but to actually put money into people's bank accounts directly, which they can do. There's actually Section 13.3, I believe it is, of the Federal Reserve Act, enables the Federal Reserve not to put money just to the banks as they're currently doing, but to put it directly into people's deposit accounts. It takes a certain majority of the Federal Reserve Board to vote for it, so it could be done. And I would do that in such a way that per capita, pro rata, based on income, all sorts of ways you could try to do it, but inject money, Federal Reserve created money, into bank accounts on condition that if you're in debt, you must pay the debt down. So let's say the amount was $100,000 per person, just for a hypothetical number. If you had debt of $150,000, 2/3 of that would be cancelled, and you have a debt of $50,000. But if you have no debt, you'd get a $100,000 cash injection. That would then work through the banking sector. The banking sector would be required to reduce its debt down. Anybody who'd bought bonds would find they had less value, less cash flow coming out of them. So they'd get the people who'd bought securitized assets off the bank would have a lower cash flow, but they'd be compensated by having a cash injection. So you'd neutralise the damage to their spending capacity by giving them a stock they could spend out of, while the debtors would have a drastic reduction in their debt level and therefore have more of their income they could spend on consumption. And you could reduce the debt level quite substantially rather than waiting for this long, slow process here of declining debt over time through deleveraging. So that's a major difference. Then I would also want to put controls on banks to stop them lending on the basis of assets, because you don't want this just to label another Ponzi scheme to start all over again. So in housing, I talk about what I call the PIL, which stands for Property Income Limited Leverage. And rather than banks being able to claim they're lending to you on the basis of your income, which of course they don't do, they lend on the basis of your assets at the moment, to limit the amount of lending that can be given to buy a property to, say, 10 times the annual rental of the property, no matter who's borrowing. I'm sure you earn more than I do. If you and I were competing over a house, we'd have exactly the same amount of money from the bank. So let's say let's say we were both fighting for a place that could earn $50,000 a year in rent. With a scheme I want, what I call the PIL, the most we could both borrow from the bank would be $500,000. If you wanted to beat me, you'd need to save more money, which you would do. So there'd be a negative relationship between leverage and house prices rather than the positive one we have right now. And that's the danger we have, is that there's positive feedback loops in the economy coming from the finance sector that causes these bubbles and then causes the crashes. So changes like that would be necessary as well. And it also monitor this level here, the level of debt to GDP, because that rising trend there is what gives you the sort of crisis that I'm probably showing over here by now. Okay? You've gone down the black hole in that particular situation. I'll stop the model at that point. So, knowing that the debt to GDP is a key indicator of the state of the economy, which is ignored by the new Keynesians, that's also a change. And the final thing is that one way that you keep the debt ratio in check to some extent is through inflation. Okay, and I'm now beginning to be convinced by some of the analysis I've done and work by other colleagues of mine in systems engineering that there may be an inherent tendency, even without Ponzi behaviour, towards accumulation of debt over time. Okay, so you have to say a bit of inflation that reduces that debt is a good thing. So being paranoid about the level of inflation, believing 2% is the desirable level, could actually be partly what set us up for this crisis in the first place. So I'd want to have more sensible tolerance about the rate of inflation as a way of reducing that debt burden over time. Because again, inflation is seen just as a negative thing from the point of view of an Austrian perspective or a neoclassical perspective all the way through. We've been ingrained to see it as always bad. What inflation does is reduce the outstanding debt burden in real terms. So those three things would make me very different to new Keynesians.
Two more questions. So you can
Yeah.
corner them. One of the major pieces of American private debt is student loan debt.
Yeah.
I'm wondering if we might enhance deleveraging in a way that's pretty fair for the government to basically buy up all the student loan debt and write it down over a 4 or 5 year period.
Yeah, and just to repeat the question about what about abolishing student loan debt. Brilliant idea, because again, speaking as an ex-academic, you may have heard my university shut down my economics degree last year, making me redundant. I'm now the world's most famous unemployed economist. This whole thing about being students financing their education, particularly in a debt-financed way, I think has actually not just caused a huge burden on students, which mean they graduate owing, like in the American case, up to $100,000, $150,000 when they leave university. They're debt slaves before they start earning their first dollar. It's also meant that students' focus is entirely on a short-term, remunerative attitude to education, which has, as I've seen over the 40 years I've been partly an academic and partly a student, it's reduced students' capacity to study. We've got a dumber workforce specialising in crap degrees coming out of this rather than the old 50s and 60s focus on solid learning and solid professions. So it isn't just a case of reducing the burden on students and reducing the burden on the economy. I think it will give us a better class of education. So I'm definitely in favour of abolishing student debt. I know that's actually Senator Warren has put forward a bill on that front, which I think is a fantastic start.
I'd just be curious to hear what your policy advice for Australia would be. I know the housing market is doing very well there, but their terms of trade have deteriorated, and the export market for iron ore and coal and those kinds of things.
Yeah. One of my greatest disadvantages of being in Australia is being in Australia, because it's the one place that reckons it didn't have the crisis. In fact, the central bank down there refers to the crisis as the North Atlantic financial crisis. I take a certain amount of credit for that happening because when our then Prime Minister was interviewed on the leading current affairs program back in 2007, it was the day after I'd been interviewed for half the program, and they got bashed around the head by the interviewer about, what about Keynes saying blah, blah, blah. Came up with the biggest stimulus package in the OECD and what I call the first-time vendors boost, where they doubled the amount of money going to people buying existing houses and trebled it to those going, the government grant to buying new houses. It restarted a housing bubble in the middle of the crisis. And in fact, the main reason we avoided the crisis to begin with was because of the increase in the number of real estate agents. I wish I was joking. It's actually true in the stats. Then China threw its huge stimulus in, so we got an enormous boost to selling to China. China had a huge slump when the crisis began, and it actually increased its money supply in 1 year by almost 30%. Literally the money supply too, not just QE type spending, which gave them a housing bubble and a construction bubble and so on, which they're now coming out of. So putting it all together, we are now at the tail, the housing bubble is over. People think our housing market has recovered. And it fell about 10%, it rose about 2%, and the bulls were all saying it's going to rise like crazy this year. One of my fellow writers on a blog called Business Spectator argued that it was going to rise by 10 to 12% so far this year. When the figures came out for the first quarter, the increase in house prices in 1 quarter was 0.1% in nominal terms. I call that a Clayton's housing bubble, and it's a piece of Australian slang. It's Clayton's is a drink you're having when you're not having a drink. Okay, so I don't think it actually is reviving as much as the bulls were hoping it would do. But that means we've lost impetus from the housing market as a way of stimulating the economy. We're losing from terms of trade starting to fall as well, and volume going down. And the government is now, both sides of politics are obsessed with going into austerity and getting back to surplus again. So I think it's going to end up slowly catching up with the North Atlantic financial crisis. If I had any impact on policy, I'd be saying don't go to surplus, but running a deficit is quite sensible at the moment. And housing debt is finally going to become a brake on the economy. We don't have the same level of aggregate debt as America, I believe. The trouble is debt is recorded very unreliably in international stats. We tend not to realise this, but we talk glibly about the unemployment rate back in the 1930s. We didn't actually know the recorded unemployment rate until the 1930s came along because the government thought unemployment was the problem of the unemployed. And most of the stats, particularly the stats that Phillips put together to give us the analysis of the relationship between unemployment and changes in money wages, was kept by trade unions. So only after the 1930s did we regard unemployment as a systemic aspect of a capitalist economy and therefore record it in any systematic way. Same thing applies with debt. Australian data does not necessarily include the debt of the financial sector, non-bank borrowing from the banking sector. The American data does. It's very hard to get consistent data. So I think Australia's debt level is lower than America's, but I could be leaving out our non-bank financial sector's debt. But given all that, we have a lower level of debt than you have. Our debt level peaked at, if I can make them comparable, your debt level peaked at 303%, our debt level peaked at 160%. But housing debt is actually higher in Australia than in America. Mortgage debt's about 86% of GDP right now in Australia. You peaked at 87%, you're down to 68%. So I have much the same prescription overall. We should be doing the same thing. We did have the same crisis, just different quantitative levels. And now we're likely to face a whole lot of headwinds, whereas beforehand we had tailwinds that made it easier for us.
Okay, thank you very much.